Welcome. Today we're going to be discussing the measurement of revenue in terms of IAS 18. Now, this measurement principle is very simple, guys. It's going to be measured at the fair value of consideration received or receivable. Okay, so it's a fair value standard. Remember, there's no initial versus subsequent measurement here. It's an income-based concept, revenue. So therefore, only measured once at the fair value of consideration received or receivable. So there's a couple of things to remember. We have a definition of fair value in terms of IAS 18 as well as IFRS 13. So let's look at IAS 18 first. So fair value is defined as the amount for which an asset could be exchanged or a liability settled between knowledgeable, willing parties in an arm's length transaction. Now, the problem there with fair values is that each of the individual accounting standards try to deal with fair values independently. Now, recently, from this year, 2013, we have a new standard called IFRS 13 that deals with fair values across the board. So this is actually the overriding definition. So the IFRS 13 definition is fair value is the price that would be received to sell an asset, paid to transfer a liability in an orderly transaction between market participants at the measurement date. Now, we are doing a separate video series on IFRS 13, but just remember, IAS 18 refers to fair values. If I refer to fair values, what standard do I need to look at? IFRS 13. The old IAS 18 fair value definition is still encapsulated in this definition. So this has just become broader and clearer. Okay. So in terms of IAS 18, fair value of consideration received or receivable has some complications or some extra things to think about. So just want to lay out that you will need to consider. First of all, you will need to deduct trade settlement discounts as well as volume rebates. You do not show discounts given as a separate line item under other expenses. It is shown net of revenue. Okay, then we must also look at what happens if payment terms are extended for no or less than market value interest rates. Well, then you'll have a time value of money issue, and that will need to calculate the present value, and you must discount always at the market interest rate pre-tax. We also need to discuss some complexities around barter or exchange transactions, very much linked into this fair value of consideration received or receivable in those issues. In the next video, you'll also need to look at the different components of revenue, and sometimes when transactions are not at fair value, okay, there might be multiple components. So revenue from sale of goods as well as revenue from services rendered. The last one that I'm also going to bring up in a separate video series is customer loyalty points or customer loyalty awards. So you go to your airline, you buy an air ticket. Generally, they will have some customer loyalty programs. So your air ticket will come with 1,000 loyalty air points, etc. Okay, all the companies call them different things. They might be Voyager miles, etc. That is dealt with in IFRS 13. A separate IFRIC deals with customer loyalty points and provides guidance thereon. So fair value considerations, let's just discuss the component saying revenue is recognized net of discounts and volume rebates. So let's say now on our invoice you have a gross selling price of 100,000 currency units, whether it be rand, dollars, whatever. And then you got a cash discount of 10%, so 10,000, meaning that you needed to pay, well, you were receiving, 90,000 units. Okay. Now, how would I account for that? The old thinking wanted to account for the gross amount as revenue and the 10,000 as an other expense. I'm telling you that that is not correct. Okay, revenue must be recognized not as the 100,000, but the net amount of 90,000. So you will journalize it, debit, bank, or debtors, credit revenue, profit or loss, with 90,000. Okay, please, I don't care what your high school teacher taught you, you do not show the 10,000 as a separate line item under other expenses. It's deducted against the revenue line item. Okay, the next one is that there may be deferred payment terms, which means there's a financing transaction component of this revenue contract. So what do I need to do? Let's assume I'm going to receive the cash flows in a future period, 6 months, a year's time. But the transaction is today. Therefore, what will I need to do? I will need to show the actual revenue, okay, not at the cash flow amount in the future, but I will need to discount that back to the present value, i.e. today's value of the contract. Okay, so on day one, I will go debit debtors with an amount. I will then credit revenue with the present value. Okay. And what's going to happen is over this time, I will increase debtors, okay, and I will then have interest income being unwound. Okay, we'll do some number crunching now, but remember, we must recognize any deferred payment terms at the present value. What discount rate must I use? I must use a pre-tax discount rate, and we'll discuss that in a bit more detail in a second. So let's take an example now. Let's assume we have a sales price of 100,000 excluding VAT. Payment is only due in 6 months, okay, and the fair discount rate would have been 12% before tax. But in this scenario, the payment being due in 6 months had no interest per the contract. So I'm going to need to do the following. I'll need to discount the 100,000 back 6 months in time. Let's do that quickly. So if I put this on a timeline, being today having transaction date, and in the future I will have receipt being a 6 months waiting period. Now, in 6 months, there will definitely be 100,000 paid to me. But I need to work out what is the present value. What is that 100,000 worth today? So I'll do the following calculation. In my financial calculator, each calculator has a slightly different process. You need to work out how that works. Okay, you will put in the future value will be 100,000. Payments, well, there's no intermediary payments for each of the months. Okay, so payments will be 0. N will equal, well, let's just go back to the question for a second. I said 12% fair interest rate before tax, but I've said assume compounding every 6 months. So what will happen here? We will have one compounding period of 6 months. Okay. Now that is a time value of money calculation issue. You've got to go through and make sure you can use your calculator and move amounts forward in time, back in time with different compounding periods. Interest needed to be the market interest rate of 12% per annum. But how many times does it get compounded every year? Twice, once every 6 months. So 12 divided by 2 equals 6% per 6 month period. Now all I need to do is compute the present value, and that equals 94,340. Okay, so I've taken the 100,000. I've gone and discounted it based on 12% divided by 2 6-month periods gives me 6%. The present value is now equal to 94,340. So, next up, we're accountants. The maths is not enough. We need to do the journal. So if I do the journal on the transaction date, which was at present value period 0, I'm going to go debit trade receivables, debtors. Okay. Now, what I would ideally like to do is go debit the 94,340. That's not a reality because auditors are going to want to see something that matches to the invoice. So I will go trade receivables gross. Okay. And that will be 100,000 exactly. Okay. Okay, next up, I'll need to do trade receivables, the unearned finance income component. Okay, and that will be exactly the 94,340 minus the 100,000. So all I'm talking about now is the difference between 94 and the 100, so 100,000 minus the 94,340. Well, that is interest of 5,660. On day one, we call that a net account or sub-account of trade receivables, and we'll offset it against the gross amount. Okay. Both of those are financial position or balance sheet accounts. The credit, well, that is going to go to revenue from sale of goods, and that is a profit or loss amount, and we've done that figure of 94,340. I've ignored any sales tax or value added tax. Okay. On the face, the disclosure, you're still going to have trade receivables on day one being equal to the 94,340. But it's going to be made up of the gross amount of 100,000 less the unearned finance income of 5,660. Okay, so this is all on day one. Happy that we've recognized revenue, the component of revenue from sale of goods, correctly at the present value of the future cash flows. But what needs to happen next is that over the next 6 months, we will now go forward from transaction date to receipt date, and we'll have to recognize the interest. What are we going to do? We are going to go debit trade receivables, making trade receivables bigger, but we're using the sub-account called unearned finance income in financial position. Every month we'll go and go and go, and we'll land up at a total of 5,660. The credit will go to interest income, which will be a profit or loss component, being 5,660. Okay, now what you've got to ask yourself is, where does this interest income go? Well, if it's in the ordinary activities, okay, i.e. we do this for all of our clients, then it will go to revenue. If not ordinary activities, then it will be classified as other income. Okay, so we're making some good progress. One more thing to consider, with the discount rate, the standard IAS 18, paragraph 11, tells us what discount rate should we use. Well, it says the imputed rate of interest is the more clearly defined or determinable of either. The prevailing rate for similar instruments of an issuer with a similar credit rating, not so easy to determine unless you're doing high volume debtors on credit. Okay? What's most likely is that you will look at a rate of interest that will discount the nominal amount, in our last example, the 100,000, to the current cash sales price of the goods or services. So nominal amount in our last question was the 100,000, whereas the current cash sales price was the 94,340. Okay. So last up to consider in this lecture for fair value measurement of revenue is barter transactions. This is when I swap this pen, okay, for a calculator. The pen is inventory for me, and I'm buying the calculator also as inventory. Okay, no cash is changing hands. So if it's goods or services that are changed for other goods or services that are similar in nature, then please note there's no commercial substance. There is no revenue recognition. All I'm doing is swapping out inventory. But if goods or services are exchanged for dissimilar goods or services, then there is commercial substance. Okay, and then there will definitely be revenue recognition. Go back to your core concept of measurement of revenue. It will be measured at the fair value of the consideration received or receivable. If I'm giving up this pen and receiving this calculator, then I will measure my revenue not at the fair value of the pen being given up, but at the fair value of the calculator being received. Okay, so that brings to end this first lecture on revenue measurement. It's very important that you get this key concept correct. Okay, if you don't get this key concept correct, you will battle both in practice and or in your academic exams. Thank you.